So the required is complete the cash budget for each of the months January to March, year 5 for Quest company. Okay, for January to March only they've asked. So we'll start from the problem here. So the following budgeted statement of SOPL has been prepared for Questco for the 4 months Jan to April. So they have given us sales, cost of production, inventory, cost of sales, gross profit, administration and selling overheads, and finally net profit. And they have also given you some information. We'll go through all the information. So the informations are 40% of production cost relates to direct materials. So what is the production cost here? So this is the production cost. 40% of these represent direct material, and materials are bought in the month prior to the month in which they are used. So if they are going to use it in February, it's already bought in January. Purchases are paid for 1 month after purchase. So purchases will be paid in the next month. So goods are first purchased for February in Jan, and Jan amount will be paid in February. Okay, so typically the same amount is paid in the same month, but we don't need to look at those things now. 30% of the production cost relates to direct labor, which is paid for when it is used. So 30% again of all cost of production is direct labor, and it is paid in the same month itself. The remainder would be another 40% of the production cost is the production overheads. Okay, so the balance 40% is the production overheads, and out of those overheads, 5,000 is a fixed cost, which includes 3,000 depreciation. So 3,000 depreciation is a non-cash expense, so that we should not consider. So the fixed cost would not be 5, it would actually be only 2,000, because we should ignore the non-cash expense. Fixed production overheads costs are paid for when incurred. So the same 2,000 will be paid in the same month. So what about the balance of the production overhead? The balance is 40%. The variable production overhead is paid 40% in the month of usage and balance in 1 month later. So that amount is paid 40% now and 60% later. The unpaid variable production overhead at the beginning of the month is 9,000. So the carried forward unpaid overhead is 9,000. So they tell about the sales. Sales are on credit. So all sales are on credit. 20% receivables are expected to be paid in the month of sale. So in the same month, the sale is going to be recovered, and the balance 80% in the following month, that is in the next month. So the unpaid trade receivables at the beginning of January is 44,000. That is, the 44,000 of cash will be collected in January itself. The company intends to purchase capital equipment costing 30,000 in February, which will be payable in March. So in March, we have to put 30,000. The bank balance on 1st January year 5 is expected to be 5,000 overdrawn. So it is a negative 5,000, not a positive 5,000. So we can work out the sum either in thousands or in full numbers. So we'll start. So we start with opening cash, then income, then total of the income, then expenses, then total of those expenses. So finally we get closing cash. So let's get each of these items. So we'll start from as per like what they have given. So the first item they have given is materials. So materials is 40% of these numbers. Okay, so we'll take a working note. So working note number 1 we'll take. So cost of production. So cost of production is 50, 55, 32.5. We don't need to do for April, so we'll just leave it. So 40% of it is direct material. So this amount, materials are bought in the month prior to the month in which they are used. So February amount, the number of this number 5522 is bought in January, and purchases are paid 1 month from 1 month after purchase. So whatever bought on January will be paid on February. That is, the same number will be in the same month. So that's what they are telling essentially. So you can work out the numbers like this. So we will now move on to labor. So labor also will have the same working note. So labor is 30% of cost of production. So out of this, 30% is paid. And they say which is paid for when it is used. So it is paid in the same month. So the next one is the remainder is production overheads. So we can find out is production overhead. So what is the balance? See, the balance is 40 and 30 is gone. So the balance would be another 30. So we can put it as balance itself, because that's how the sum has told us. So 50 minus 20 minus 15, it's 15, 16.5, 9.75. So this is a balance. This balance is split into two parts. So one is the fixed overhead, fixed, or else we can put it like this. So fixed is 5,000 in each month. Okay, but if you see here, fixed production overhead costs are paid for when it's incurred, but includes 3,000 of depreciation. So we can put it like this. We don't need to refer the working note. So 5 is the fixed production overhead, out of 3 is the depreciation. So we can put it as fixed cost minus depreciation. So that is the working. So thereafter we can find out what is the variable cost. I think we can put it as FC, this as VC, So what is the variable production cost? It says the remaining overhead is a variable. Okay, the remaining is out of 15, 5 is fixed. So the balance is variable. Okay, so this is what is the production overhead, which is variable. And what he tells is the variable production overhead is 40% paid in the month of usage, and the balance is paid in the later month. So we could divide this number like this. Fixed production overhead. Okay, I think we'll cut short like production overhead VC will be paid as cash and also as 1 month. So 40% is paid as cash. Okay, 40% is paid as cash. The balance is paid as 1 month delay. So balance would be 10 minus the 4, 6, and then okay, 11.5 minus 4.6, 6.9 will be paid here. So we can copy both these and we can paste it. I think we've already copied the we'll paste it here. So these are coming from working note 1. Okay, done. So he says there is an unpaid production overhead at the beginning of January. So the unpaid will be paid in the, so all the subsequent months are being paid. So 9 would be paid in January. So January's 6 is paid in February. February 6.9 is paid in March. So December's number will be paid in January. So that's where we get this number. So what else we have still? So we have the admin and selling cost are paid quarterly in advance. On 1st Jan, April, July, or October, the amount payable is 15,000 per quarter. So the only month that falls here is the January 1. So on January 1, we have to pay 15. Admin overhead, we have to pay 15. Thereafter, we have all sales are on credit. 20% receivables are expected to be paid in the month of sale itself. 80% in the month following. Unpaid at the January. So the December credit is paid in January. That amount is 44. So first I think we'll take with the 44. So there are two sales. So this is cash sale and there is credit sale. That's cash sales and credit sale. So cash sales would be I think we need to put a working note here again. Working note 2. So first we'll put total sales. So total sales comes to in January it is 60. February it is 50. March it is 70. So the rules is the same month we get 20%. So the next month we get the balance 80%. Okay, so sales is, we can put like this. This is 20% of sale. This is 80% of sale, and this is has a 1 month credit period. So we got these numbers. We can just copy them from here and we can paste it in this place. So the opening balance would be, the opening payables is 44. The company intends to purchase capital equipment costing 30,000 in February, which will be paid in March. So in March we have to pay 30. And finally we have the bank balance on 1st January is expected to be 5,000 overdraft. So overdraft is 5,000. So the total income would be the sum of all these numbers, and the total expense would be sum of all these expenses, and our closing cash should be total income minus total expenses. Okay, it is minus 14. Just let's check once whether we have left out any other number. Okay, I think we have done all the numbers. So the closing cash here will become the opening here, and again we'll find out the total income, we'll find out the total expense, we'll find out the closing here. So opening is minus 7.1, total income is this number. Okay, so that's about the problem here. We have got our answer. So hope you guys got an understanding here. So cash budgets are not like very identical. They are like same, but we can't say they are identical. So each problem has its own unique kind of differences. This problem has like differences like we do all the working notes. Okay, from working notes we have taken the numbers above. So ensure that you understand the working notes, because understanding working notes is much more difficult than understanding the cash budget in this problem. So that's about this problem. We'll move on to the next one.